My name is Steven, and I'll be the moderator for today's conference call. I welcome you all to Allcargo Logistics Limited business update call. We have with us from the management, Mr. Deepal Shah, Chief Financial Officer, and Mr. Ravi Jakar, Chief Strategy Officer. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ravi Jakar. Thank you, and over to you, sir.
Yeah, thank you. Good afternoon to all the participants. Thanks for joining the call. I hope that your family and friends are all keeping safe for their well-being. Amidst the rising cases of new variants, let us all continue to exercise greater caution. Coming to the point for today's discussion, today is a historic day for the company as we speak about the proposed scheme of demerger which has been approved by the board of Allcargo Logistics. This proposed demerger would allow our businesses to drive the next phase of growth as they gain strategic independence and financial and operational flexibility. All businesses will continue to be part of Avasya Group and continue to enjoy the support of all the group-wide centers of excellence created to support business and drive growth. Over the last 15 years, since the company was listed on public markets, we demonstrated strong growth at nearly 15 to 20% between December 06, which was the first annual results, and September 21, the latest audited results, increasing revenue to nearly 14x and EBITDA to nearly 11x. This growth has been made possible by entrepreneurship, innovation, and commitment of people. We have managed to build, nurture new businesses, grow and scale existing businesses by way of organic and inorganic growth. Over the period, we have become global market leaders in LCL consolidation, made a significant presence in express as a premier player with acquisition of Gati, a dominant player in contract logistics, particularly in the chemical segment, market leaders in CFS operations, and also have robust businesses in grade A warehouses with best-in-class assets leased out to marquee clients. All of this has meant that the company has continued to grow, and now that some of these businesses have gained the scale and require strategic independence to operate with greater flexibility, both financially and operationally, so that they can be more efficient and drive the next phase of growth. Keeping in line with this strategic requirement, with a long-term view of creating more robust businesses which can drive better growth, the board has approved the proposed scheme of demerger, which would lead to demerger of CFS ICD business into Allcargo terminals and the demerger of real estate, including warehousing, logistics parks, and other rental businesses into Trans-India Realty and Logistics Parks Limited. Allcargo Logistics would continue to focus on international supply chain business and explore organic and inorganic opportunities. It would also continue to hold the shareholding in Gati and ACCI, driving growth in express and contract logistics businesses. The CFS and ICD business would now get demerged into Allcargo terminals, which would operate all the CFS and ICD. And as an independent business undertaking, the company would have the required sharp focus from management, ability to attract the right capital, ability to operate with the right flexibility and the right strategic structure to expand and grow in possible business opportunities. I would like to highlight that this is a very efficient business which does not focus on ownership of assets. Rather, Currently, 5 out of our 7 CFS and ICDs are already on a lease model, whether lease from JNPT Port, Container Corporation of India, CWC, or other organizations. And now, under the proposed scheme of demerger, as the real estate part of the 2 CFS at JNPT and Chennai would also go to TransIndia, CFS ICD business will become even more efficient with on a completely asset-light approach. And as the market leaders in CFS, the business will be poised for growth in ICD, where we are expanding our footprint on the back of transformational change in the rail infrastructure in the country with commissioning of the dedicated freight corridor, with particular focus on the Western Dedicated Freight Corridor, where company already has an ICD in Dadri and an upcoming ICD in Jhajjar in NCR. The Allcargo logistics would also be demerging the real estate business, which would now operate post the approval of the demerger scheme by shareholders, regulators, and all, with all the necessary approvals required under the TransIndia Realty and Logistics Parks. Under this business, we would continue to build a portfolio of high-yielding rental assets. This includes the equipment rental business, which provides for strong cash flows, and also all the Grade A warehousing assets that have been built over the years. A part of that is already under discussion with Blackstone, and the shareholding in Blackstone joint venture would also be held under TransIndia Realty. In addition, the CFS infrastructure in Chennai and GNPT would also be transferred into the Realty division, which would lease it back on a long-term lease as required by the operational needs for the CFS ICD business. In doing so, we would create a very powerful realty and logistics parks company, which would continue to build the best-in-class assets. If you look at Grade A warehouses, there's a huge demand in the country right now, which is likely to sustain in the medium to long term. And the company, having built close to 5 to 6 million square feet of such warehouses leased out to marquee clients like Amazon, Flipkart, Decathlon, etc., is already in a strong position to now drive the next phase of growth. As this business gets separated from the logistics business, it would find its much-needed strategic independence and be able to attract the right pool of capitals and find sustained growth opportunities. So therefore, the proposed scheme of demerger would facilitate the CFS ICD business to grow under Allcargo Terminals, the Realty and Logistics Parks business to grow under TransIndia Realty and Logistics Parks, and the other businesses on international supply chain, express and contract logistics also find sharper management focus and ability to continue to drive growth at higher than market growth rate, thereby increasing market share with an asset-light, digitally enabled growth approach. In terms of the scheme of demerger, it is a very simple scheme for shareholders, taking care of all the shareholders, including the ones with smallest shareholding, to minimize the hassle to them. And therefore, the board has accepted the recommended structure of 1:1, which means that for every 1 share held in Allcargo Logistics, the shareholders would get 1 share each of TransIndia Realty and Logistics Parks and Allcargo Terminals, in addition to continuing to hold 1 share of Allcargo Logistics. The shares issued in Allcargo Terminals in TransIndia would be listed on BSE and NSE, and the entire process is likely to take anywhere between 12 to 15 months, considering the approvals required from exchanges, SEBI, shareholders, and then it goes into NCLT approvals, and subsequently, post NCLT approval, additional time is required for the listing of newly created public companies. All this entire process is likely to take 12 to 15 months. During the course of this 12 to 15 months, the businesses would continue to drive growth, focusing on strategic opportunities, keeping in mind the long-term vision of creating large businesses in each of these strategic business undertakings, which are being created by way of this proposed scheme of demerger. This is all that we wanted to share with you on the proposed scheme of demerger, and happy to answer any questions that you may have around the details. I also hope that you all have had a chance to look at the presentation, which has been updated to take into account the demerger details, and we have shared the further details about the rationale as well as the implications of the proposed scheme of demerger. So that's all from my side, and I would like to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Prashant Kumar Hazariwala from Solitaire Financial. Please go ahead.
Hi. Good afternoon, sir.
Hi, good afternoon.
Congratulations for such a good demerger scheme. I would like to know I have one question that Trans India Realty has a very high capital employed, 1,696 crores, right? So once we complete this Blackstone deal, then what will be the capital employed after that? And how much will be the interest portion for this company, Trans India Realty Logistics? Thank you.
I would request my colleague Deepal to respond to that.
Yeah, thanks, Ravi. So, you're right. The capital employed for Trans India is higher because all the assets, including the Blackstone portion of the assets, have also been moved there. But it would not be right for me to share an exact number, but we would say more than 50% of the assets would actually go with Blackstone, and balance would stay back with us. Depending upon, there are some contours of the deal where they would want to acquire some more assets. So only time will tell which exactly the assets which are moving. So there is a large part of assets which are definitely moving, but if they take interest in acquiring some more of them, we would evaluate at that point of time. So, but the short answer to this is yes, more than 50% of the assets will move out of this in terms of capital employed.
This Blackstone deal is going on since more than last 1 year, right? So how long it will take to complete this deal?
Yeah. So let me, Prashant, update you that most of so more than 1 year because there was construction which was pending. So
okay.
Most of the construction is already through. In fact, like we mentioned earlier, most of the assets, in fact 4 million square feet was forward leased. So all the leases are also started to operate now. There are 1 or 2 CPs which are still pending, which we expect to complete in next few months. And we all have to recognize that many government offices and many areas were not fully operational through the whole COVID period, due to which the period has got a little bit elongated. As far as what is within our control, that is the construction, onboarding of customers, starting of the lease, and getting an ARD around that, most of this is as per timelines that we expected, and it's going well.
All right. So how much more time we can expect, like 6 months or something like that? I mean, tentative. Like I'm not asking for exact time.
If I can just add to that, there are 2 parts to it. One, there are certain approvals which are part of larger government plans, master plans for that particular area, which needs to be worked upon, which are completely beyond our control. And if not for the COVID, those things would have already happened. Our current estimate is still about 3 to 4 months. We should see that concluded, which means that within this financial year that should get concluded. But this is only a best estimate because we cannot predict how some of the government initiatives would run depending upon their priorities and closures in the working of government offices. But I would like to clarify and highlight, like my colleague Deepal said, this does not have any impact on the business whatsoever. The construction has been completed on schedule, the lease have been signed, we've even been able to draw down the LRD financing. So all from a business perspective, these are highly best-in-class assets in high demand. Most of them are pre-leased before even the construction begins. So these are like marquee assets leased out to marquee clients, and there is absolutely no disruption on the operational side, be it construction, which we have managed to complete on schedule despite all the COVID restrictions, and the facilities are already leased to various clients. And in the course of last 3 to 4 months, significant construction has also been completed, which means that it will start accruing more increasing rental in the next 3 to 6 months to come as the rental accrual begins. So on an operational standpoint, these are marquee assets, high-class clients, and everything on schedule. In terms of the agreement with Blackstone, that required certain government regulatory approvals to be in place, some changes which are beyond our control. But at this point in time, again, our best estimate is that in the next 3 to 4 months, it should get concluded.
All right. So one more question is like the same thing. Assume lease rentals of 120 million for Chennai and JNPT CFS land. So is it like we from Trans India Realty we have leased these two assets like Chennai and JNPT CFS land to Allcargo terminals? So how does it work?
Yes, so it is not being leased. This is a proposed scheme of demerger. Once the demerger gets all the necessary approvals and becomes effective, the appointed date is 1st April 2022, and the scheme approval is estimated in anywhere between January to around January, February 2023. So once the scheme of demerger is effective, and these companies exist with the demerged businesses, at that point in time, Trans India Realty would be owning these assets and would lease out to Allcargo terminal. So that is the right understanding, but it is not as of today. It is part of the proposed scheme of demerger. As of today, everything is part of Allcargo Logistics. The demerger has to take place for this to be effective.
Right. So my question, like, I would like to know why we have kept these two property in Trans India Realty, because it's a CFS business, right? So why we have not transferred it to Allcargo terminals and kept it into the Trans India Realty?
Yeah. So basically, from a CFS perspective, one, we want to keep it an asset-light business. We don't want it to be linked to certain assets. It gets its operational flexibility. If it finds opportunities to get more locations, explore new locations, all of those flexibilities remain with the business. Business is not bound by any capital commitment. The business can take its own strategic direction. It already has an access to this land for a long-term lease. The business has flexibility to plan as per its strategic needs, and which is why owning the assets is not something we see as of any significant advantage in managing and operating the CFS business. A long-term lease is perhaps more attractive if we think as just a pure CFS ICD operator. And that is exactly what has been the broad rationale for this demerger, to allow businesses to gain that strategic independence and operate in the most efficient and optimal way. And given that, like for an example, like I mentioned, 5 out of the 7 CFS ICDs are already on a lease model. And we find that to be a very effective and efficient model for the business. And which is why we have converted the other 2 also in the same model.
All right. So these 2 are our own, but we have transferred it to rental, this Trans India, and then they will lease it to CFS, right?
Yes, and so the other 5 are already in that lease model.
All right. So everything will be on the lease model. So going forward, if you want to, this is a continuation of the question, right? Last question. So our business model will be we'll buy if we are going to expand our CFS business, we'll buy land from Trans India and lease it to Allcargo terminals, right?
No, that is not the interpretation. Both businesses are independent strategic business undertakings. They will take a decision in their interest. It is not that Allcargo Terminals has to depend upon Trans-India Realty. Trans-India Realty will look for opportunities to buy a highly attractive, best-in-class assets which can be leased out. Allcargo Terminals will look at opportunities that are of strategic interest. It could be CFSs, it could be ICDs, it could be leased from Trans-India, it could be leased from any other party as well. Like I mentioned, 5 other CFSs are leased from other partners. So they are strategically going to be independent. There's not going to be any interlinkages of that nature.
All right. No problem. Thank you very much. All the best.
Thank you.
Thank you.
Before we take the next question, a reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Prateek Kumar from Antique Stock Broking. Please go ahead.
Thanks for the opportunity and congrats to the team for this kind of demerger announcement. My first question is, so while we have announced this now, so and this is after like we have added a couple of businesses in like last couple of years. So has this kind of this kind of announcement or would have gone through promoters or company earlier as well in past 5 years, because as we have known historically that the company has always been a sort of a multi-dimensional, multi-sectoral company. So I'm sure there would have been investor feedback in prior times also regarding such kind of demerger. So why now particularly? And so that's my first question.
Yeah, thanks. And that's a very valid question. And the strategic rationale clearly is driven by business needs, and we value investor and analyst feedback that we receive as well. However, what we recognize is it is important for a business to get the requisite scale as well. Otherwise, strategic independence may not necessarily be a step forward. And therefore, we did not feel that maybe 5 years ago, to answer your question, it was at the right scale. Now, with the growth that we have seen and with some acquisitions that we have done, let's say in the CFS ICD business, we believe that the company has the requisite scale. And with the opportunities ahead, we believe it is the right time for the strategic independence and financial and operational flexibility. Similarly, on the real estate side as well, it was work in progress. Now there's a good portfolio of assets which have been created, delivered, and leased. And therefore, the company again is in a strong position to build upon this foundation and drive growth. And that is where, when the company's board considered this proposal at this point in time, it was convinced that this is the right step forward, providing the strategic independence as the businesses have the optimal scale to be demerged.
Okay, thank you. My second question is on Trans-India Realty and Logistic Park business. So now this business is primarily a real estate business, right? This will not have a service component, unlike for other segments where we are like a service operator. This will largely be a warehouse which we will lease to, warehouse or land company, where we will lease assets to whoever wants to build warehouse or operate warehouse there, and will not be providing any service.
Yes. So to answer that, just a few, broadly you are right. Just to add a few clarifications, it would own various rental yielding assets. This could be warehouses, it could be CFS, it could be cranes and equipment that we own. But they are largely the focus is on creating assets which can be leased out. It won't be land on which somebody can build warehouses. The company would look at constructing the logistics parks and then leasing them out. That is the model that it operates with. So it acquires land, then warehouses are built, and then they are leased out to clients like Decathlon, Flipkart, Amazon, or some of the logistics companies, including our group companies. So that's the business model. That's what will continue. And it could potentially explore. Now with the strategic independence, it will craft out its own business plan. It can find opportunities in similar space. But yes, the fundamental point would be to invest in assets which can create long-term sustained lease or rental returns. It would not be an operating service entity. as compared to the other businesses which are all operating service businesses, and which is also the reason for the demerger, since it is potentially different and requires the strategic independence to push for growth.
Regarding the project and equipment business, I see that equipment business is included in this segment of real estate, and project logistics, I'm not sure is in which segment. And we have also talked about selling some of the core assets in this equipment business. So yeah, this is clarity on where is project logistics and what is the status on, selling.
So that's a great follow-up to your last question. As you yourself mentioned, project logistics is a service business and therefore would continue to form part of the Allcargo Logistics, which it is part of today. The equipment business is more rental business, and which is why it will strategically fit in with the lease and rental business of Trans India. In terms of the within the businesses, we have continued to divest non-core businesses, non-core assets, the crane fleet and specialized. All of that would continue. The demerger only provides for greater flexibility in making plans for future.
Thanks. One last question on the Jhajjar Logistic Park, which is I think one of the 7 ICD cum CFS which we have had. I remember in 2015-16 we used to own land also there. So while we are not mentioning land ownership and restricting on land ownership.
So let me clarify on that. So Jhajjar is a combination of logistics park which has warehouses built and leased out, and it is also the proposed ICD. So considering the same, the entity that owns the land and buildings in Jhajjar is already undergoing through a scheme of demerger, which is near completion. It was announced almost a year ago, 10 to 11 months back, whereby we are in the process of segregating the ICD part and the logistics parks assets. Under this scheme of demerger, the logistics parks assets, which are your real estate play, will go to Trans India Realty, while the ICD part will stay back with Allcargo Terminals. So that business
will not have land ownership.
That's a very minimal land ownership. The 95% of the capital employed is towards land and buildings for warehousing logistics park, which will go to Trans India Realty.
Thanks for all the answers. I'll get back with you.
Thank you. The next question is from the line of Abhijit Mitra from ICICI Securities. Please go ahead.
Yes, thanks for taking my question. I have 2 questions. Firstly, on debt, if you can sort of draw down the distribution of debt in these 3 entities now post the demerger process. And my second question is on Gati. How does Gati now fits in in this entire structure? It has been retained in the main entity, as we can see. But what are your plans with this entity going forward? If you can lay down that as well in whatever way you can. Thanks.
So let me take the second question first. At this point in time, there is no change in strategy or approach or holding in Gati. The current scheme of demerger pertains to the CFS ICD and the real estate and rental business. All the other businesses continue to form part of Allcargo Logistics, and we see those businesses be synergistic in terms of being asset-light, digitally enabled businesses, and there are no further plans on Gati as part of the scheme of demerger, which pertains to the CFS ICD and the realty business. On the debt side, I would request my colleague Deepal to throw some light on the principles on which the debt distribution will happen across the demerged and the continuing business under Allcargo Logistics. But let me also highlight before that the process is going to take 12 to 15 months, and during the course of this time, there will be repayment of debt from internal accruals. So the debt position is something which may be a little dynamic from what it is today to what it would be at the time of formal listing of the 2 entities. Deepal, if you could throw some more light on that.
Thanks, Ravi. So yeah, you're right. Debt will be a little dynamic as we go along, but the principles are very clear. So whatever debt is for a respective business will move with that respective business. So if there is debt which is purely for construction, and if it's a lease rental discount, which is part of the Trans India Realty business, that those portions will clearly move there. Debt which is primarily for working capital, which EQ business holds a lot of working capital debt, and India business for MTO will stay back. And if there are any other loans which are related to the MTO business, will stay back. As far as CFS, that will be very little debt which will be moving, because CFS has been generating a significant amount of cash flows over the few years, and there is not much other than some recent acquisition debt. Other than that, nothing will move there. So that these are the principles. But yes, this is dynamic, and if, for example, some of the deals like the Blackstone deal or anything is concluded, then debts will shrink accordingly or will change accordingly. Thank you.
Sure, but those numbers, the debt number in Allcargo terminals and Trans India, so Allcargo terminals, Allcargo logistics and Trans India Realty, I think the biggest debt would be Trans India Realty, and as you said, that terminals would have hardly any debt. So
no, it's not necessarily true that Trans India will be having the biggest debt, because Allcargo logistics will carry also the debt for at a consolidated level for also the EQ portion, which is the working capital debt, and also the debt which is part of the Gati business. So, and there are some common debt which will be distributed as per the principles of the demerger scheme. So these details are being worked out, and as and when the time is appropriate, we will share the details with everyone.
Sure. And just to follow up on Gati, now majority of the business is hosted in a follow-on subsidiary, which is Gati KWE, where there is a 70% stake. So how to sort of simplify this structure now? So under Allcargo Logistics, there is Gati, and then under Gati, there is Gati KWE, where the main business is sort of hosted. So is there any thought where there is a 70% stake? So is there a thought of sort of simplifying this structure further, or that is not yet?
So like I said earlier, at this point in time, the thought process and the scheme of demerger is restricted to the CFS, ICD, and the realty businesses. We would continue to evaluate what's in the best interest of the business, and if there's any update, we will proactively share.
Sure. Thanks. And there is no change in capex plan also, I'm guessing, between Allcargo and the consolidated entity.
Absolutely. There's no change in capex plan. There's no change in business plans in the immediate short term. In the medium term, naturally, the two businesses which are gaining strategic independence will now have greater flexibility and will have an opportunity to expand their business ambitions. And those business plans are likely to change, aiming for more growth, be it CFS, ICD, or the realty businesses. But there is no impact on the capex plan or any short-term changes.
Okay, great. Thanks. That's all from my side.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Chetan Shah from Abacus AMC. Please go ahead.
Yeah, hi. Ravi, congratulations and best wishes to entire team. Just two quick questions. First, in couple of questions, you spoke about opportunity post demerger into various entities. We do got about ICD, CFS part, and also about the real estate part. And you nicely articulated about the Gati's opportunity, which is also there in your presentation, which you shared in the morning. Could you just give us some sense about our overall MTO business, how do we see this evolving? We have done couple of acquisitions in last 2 years and which is also under a consolidation and getting it aligned with our core activity. So if you can give us some sense, how do we see that part of business and in the changing business dynamics, how things will evolve in next couple of years? Because now it will be independent to the two I would say capital guzzling business, mainly the real estate part of the business.
Yeah. So basically, like I mentioned, Allcargo will continue to have the international supply chain business, for which the India business is part of the parent company itself, and the international business sits under the subsidiary EQ Worldwide, and express business is under Gati, and contract logistics business is under ACCI. Across all the three businesses, the businesses continue to maintain robust growth outlook. We have been increasing our market share across all these businesses, and we remain confident of continuing to increase our market share, which means that all these businesses would continue to grow faster than the market growth rate. On the acquisition, we have had a strong track record historically, and the recent acquisitions have also been highly value accretive. Be it the acquisition of Gati, which got completed in April last year, or the acquisition in Nordicon, which was done in July this year. We also had a small follow-up acquisition in Denmark to further build the presence in Nordicon, or the CFS business that has been just concluded last month. All these acquisitions have grown significantly from the time that we acquired. So whatever transformational initiatives we took in Gati, strategic initiatives we took in the Nordic region, or our support in the CFS business is continuing to grow these businesses. So that's a quick update on all the acquisitions. They are very healthy and continue to grow significantly. And under this demerger, these businesses now would have the strategic independence because the other businesses are being demerged. So that would also make these businesses stronger while providing the opportunities for growth to both CFS, ICD, and the realty businesses, which have very unique different requirements, and now they can take care of them.
Thanks, Ravi, for this. Just a small follow-up on that. This Nordic acquisition which we did, could you just give us, because during that acquisition we have spoken about some of the synergies and cost saving and things like that, and also in terms of our market share gain in that part of the geography. And that time also you spoken that there are some still missing jigsaw. So will that make the whole process a little faster, or that is independent to this entire demerger process? I'm just trying to understand the better market share gain in the geography, and there are some countries which we are still missing, which we were always exploring, irrespective of this whole corporate restructuring process.
Yeah. So I would say that irrespective of this corporate restructuring, those opportunities continue to be evaluated, and we continue to work on various acquisition opportunities in countries where we believe we can get stronger by way of inorganic growth. On Nordicon, just to give a broad ballpark idea, if you look at the year 2020, which was before we started engaging with them, whatever the quarterly run rates were in terms of the bottom line performance for Nordicon, in the recent quarter since EQ acquired, the numbers are already more than double. So that's the kind of impact and growth we have seen in the Nordicon acquisition. And these are strategic opportunities for us where we are able to add significant value and drive growth. And there wouldn't really be any impact because those have always been the most strategic priority to find such opportunities, and we'll continue to look for that. So this restructuring would not really make any impact on that, to be honest.
Thanks, Ravi, and wish you all the best and have a happy and healthy 2022 to all of you.
Yeah. Thanks, Chetan.
Thank you.
Thank you.
The next question is from the line of Sailesh S. from BNK Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. My question is pertaining to logistic park business. So to support the pending this warehouse logistic work and the interest payment, this Blackstone had given 300 crores OCD to SPV. This is put option. That means either entity should go for listing or we need to give minimum percentage as a interest obligation to the Blackstone. So what is the actual agreement between us and Blackstone? Can you give more color to this? That would be helpful. And also can this deal be extended in case of any delays in getting government approvals? So what is the exact terms between us and Blackstone?
Yeah. So just to add a few points before handing over to Deepal for a detailed response, the deal timelines have already been extended a couple of times because, as I said, these are marquee assets and very attractive for any investor. And the challenges are external to us, and it is well understood by the partner as well. And therefore, there is flexibility on that side. In terms of money which has come in as convertible instruments, which is still sitting as debt, would naturally form part of the Trans India entity because that is where the entire realty business is going. However, the Blackstone transaction is likely to get consummated before the demerger gets approved, and therefore that may not be really relevant in the final demerged entity. I'm not sure what further details can be shared from the Blackstone agreement, but I would request my colleague Deepal to throw further light on it.
So, Ravi, thank you. Yeah, we are bound by confidentiality, so there are not much of the details that can be shared. So you very rightly said that we strongly believe that the Blackstone will be consummated before the actual demerger takes place. As far as I think there was a concern regarding the interest portion. So we would like to bring to your attention that in a couple of months, starting April, I think for next year we should be able to generate almost more than 100 crores in terms of lease rentals for that entity. So that would be a fairly good amount to fund service any obligations that organization has till the Blackstone deal is completed. So I hope that answers all the questions.
Yeah. Okay. Thank you.
Thank you.
So you have any further questions?
No, sir.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is a follow-up from the line of Prateek Kumar from Antique Stock Broking. Please go ahead.
Yeah, thanks for the follow-up opportunity. My first question is on what kind of annual capex requirement would be there for all these three entities now? I mean, now we know that they are separate, so capex requirement in the three segments.
Yeah, so on the capex side, there wouldn't be any change from the current plan. However, to give a color on the different entities, the international supply chain, express and contract logistics business doesn't have any significant capex requirements. Most of the capex requirements are towards IT infrastructure and building digital capabilities, which is not very significant and is a very minuscule part as percentage of revenue. So no significant capex is required in any of the businesses which are under Allcargo Logistics. There are some minor investments in contract logistics to the tune of 15 to 20 crores a year, which is towards various fitments or additional items to be put up in the warehouses when they're being operated. But those are again not very substantial capex, and those are literally amortized over a short period of time and billed back to the client. Beyond that, on the container freight station side, the idea is to minimize the capex investment, and in the immediate term, there are no capex requirements. We would evaluate the opportunities to set up additional ICDs around the Western Dedicated Freight Corridor, and we are also evaluating opportunities to partner with realty companies as well as on a standalone basis or some opportunities basis as well on both CFSs and ICDs on how those could be built. Immediately at this point in time, there's no proposed outlay in the near future. And for a midterm plan, we would perhaps be in a position to share more details over the next 4 to 6 months as we look ahead. On the Trans India Realty side, the construction is almost complete for the entire land bank, which is in possession. Now, however, with the strategic independence, it is a great business model because the way it can operate as a strategic independent unit is that you invest into building an asset and that asset gets leased. As the asset gets leased, you are able to draw down LRD, which is lease and discounted debt, that can be reinvested into building additional assets. And the LRD is self-serviced by the lease which gets generated from these warehouses, and which is what makes this business also very lucrative, because over the period of 10 to 11 years, which is the usual lease contract period, you are able to service back the entire LRD, and therefore by that time you would have had capital appreciation in those assets, and the debt would have been paid off. So which is where you could this business attracts significant capital, as we have seen from large investments being made across the country in such opportunities. So we believe that now, as a strategically independent unit, this business division would now be a standalone company and would look for its own business plan. At this point in time, there isn't one that is ready. We would work upon the right management structure, business plan, and post demerger, there should be substantial capex investments in this company, which would be coming from capital recycling basically, and some additional investment by way of debt or equity that may explore. Too premature at this point in time to comment upon the quantum, but yes, directionally this would be an asset-heavy business which would look at investments which can be highly value-creating by investing into high-quality rent-yielding assets.
Thank you. My second question is on this Blackstone deal. So, in relation to this delay, either from our side, likely not from our side, but probably from government approval side. So, is there some kind of penalty or compensation which any of the parties owe to anyone?
No, there is no penalty as such, or no negative impact of these delays. These are structured, as I said, the partners appreciate and understand that delays are beyond our control, and therefore there are no penalties as such which we are paying for these delays.
And last question on the Allcargo multimodal transport operation segment, supply chain segment. So recently, as we also published on exchange, that we were looking at fundraise in that segment, and we have appointed a banker there. So investment coming into the company now versus investment like now with the scheme of demerger, or the investment in earlier case when the company was like sort of together, would that have made any difference? And this may be a reason for this kind of split?
No,
it's not really the case.
No, that's not really the case, because as you would have seen from the announcement, we have shared that the bankers have been hired in EQ Worldwide, which is a subsidiary company and which does not get impacted by any of this restructuring, because that remains a subsidiary of Allcargo Logistics, and there's no impact of this restructuring on that business. We have appointed advisors to advise us on potential fundraise opportunities to drive the next phase of growth. And naturally, there aren't any capex requirements. So the opportunities for growth in that business are built around further consolidation to achieve scale, and also on the digitization. So we are evaluating opportunities, and we have appointed advisors to evaluate them. But there is no bearing of the scheme of demerger on any of those plans. Those are completely independent plans to evaluate growth opportunities in that business.
But unlocking of a value for those investors, which may be financial investors for EQ Worldwide, would have happened by stock price of Allcargo only? Or how would have that happened otherwise?
No, an investor coming into an EQ Worldwide would not really So basically, the fundraise discussions are at EQ Worldwide level. They do not have any so at the subsidiary level. Right? There's no impact on the scheme of demerger. And Allcargo, there's not an investment being raised in Allcargo, as we have clearly stated in our communication. The advisors have been appointed for evaluating fundraise opportunities in EQ Worldwide, our subsidiary, not at Allcargo level.
Okay, thank you, and I'll get back with you.
Yeah, thanks.
Thank you. The next question is a follow from the line of Sailesh S. from B&K Securities. Please go ahead.
Yeah, thanks for the opportunity again, sir. So any updates on the management team with regards to the new entities? Will it be professionally run and managed with full autonomy?
Yes, absolutely. I can confirm that like we have had the approach currently, wherein all the businesses are run by independent professional management teams. In the revised structure under the proposed scheme of demerger also, it would continue to be the same approach with professional management driving each of these companies and underlying businesses. We would be working on the management plans. As you would appreciate, for it to be operational, there is a significant amount of time at hand, and therefore during the course of coming months, we would be making plans on the amendments to the management structure which might be required in view of the demerged entities being created, and we would share the details at an appropriate time.
So what would now remain in Trans India after the completion of Blackstone deal? Any key business which we are exploring under this entity in future?
So out of the logistics parks which are part of Allcargo Logistics, some of those logistics parks are part of the Blackstone transaction. One is an optional entity which needs to be discussed further. And then there are a couple of logistics parks assets which are not part of the transaction. So those will continue to be part of the Trans India Realty, then the Chennai CF and the JNPT asset land, and the equipment rental business, which is also we have already divested the whatever we felt was not core and strategic in terms of the equipment that we own. So all these high quality rent yielding assets would continue, and like I said, as strategically independent business undertaking, the company would now have the opportunity to look for growth avenues.
So any rough cut business-wise percentage bifurcation of first half FY22 debt number? I don't want an exact number, but still broad segregation would help.
So broadly, I would say that Allcargo Terminals, the CFS entity, would not have any significant debt. It will be near debt-free. The Allcargo Logistics will retain the debt which has been taken towards working capital in EQ Worldwide, India, piece of MTO operations, contract logistics, Gati, or the other corporate debt which has been taken, let's say, for the acquisition purposes, etc., in those businesses. However, any lease rent discounting and the loans which are pertaining to Allcargo Terminals would go into pertaining to Trans India Realty would go into Trans India Realty. I would recommend, since the debt is more dynamic, if you want to evaluate and understand how the businesses would look like, it would be better to look at from an enterprise value perspective, keeping the debt numbers to be a bit dynamic in that sense. And from an enterprise value perspective, and from a so what will happen is, clearly, as you would have seen, there's a significant amount of capital employed which goes out, which makes the business more efficient. The return on capital employed goes up significantly. And the CFS ICD also, under this unique model that we are creating of all the CF and the current ICD assets being on lease, also makes it very lean, efficient operation. So that's the way one could look at. In terms of the exact debt numbers, in the coming quarterly results, we will share the latest position as of 31st December, because in the scheme currently, some numbers are based around 30th September, while some transactions have happened beyond that as well. So I think it will be most appropriate to start looking at on a quarterly basis. We will share details on how it looks like across the proposed structure as well in the coming quarterly results. So for this month ending December quarter, we'll share the details.
Okay, thanks.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one. The next question is from the line of Kashish Sambhwani from Najan Capital PMS. Please go ahead.
Hi, thanks for taking my question. My question is related to the CFS ICD business which we have. So we have grown at roughly 8 to 10% CAGR over the last many years, and the expected growth rate in the industry is on the similar lines. I'm referring to the presentation. So I just wanted to get a sense of the growth profile. How much growth can we expect, let's say, over the medium term? I also see that we have done speedy acquisition recently. So combined organic growth, which we can have from our existing ICDs plus inorganic growth, what kind of growth profile are we looking at?
So we would not be in a position to share guidance on future numbers, but like we have shared in the past as well, I would like to reiterate that we would continue to increase our market share, which means that despite being the market leaders in CFS business, we are confident of growing it faster than the market growth rates.
Okay. I didn't want the exact number, but we'll be continue focusing on the inorganic opportunities as well?
We believe that organic and inorganic growth opportunities are equally important from a strategic point of view. And if you look at the history of the company, we have demonstrated it successfully, having completed over a dozen acquisitions across the globe, diverse cultures, diverse geographies, and all of them have been successful for the group. So there's an inherent strength in acquiring companies and integrating them and turning them around. So all of those capabilities will continue to be put at use and in driving the growth of the businesses.
Okay, thank you so much. That's it from my side.
Thank you. Ladies and gentlemen, due to time constraint, we won't be able to take further questions. I now hand the conference over to Mr. Ravi Jakar for closing comments. Over to you, sir.
Yeah, thank you all for joining on the call. Hope we have been able to provide the answers to all the key questions. And as we move forward, quarter-on-quarter basis, we would continue to provide additional information till the time the demerger actually gets effective. We would keep it transparent and make an endeavor to provide the maximum information that we can provide to our shareholders, investors, analysts to understand the company's business better. And thank you for joining us on the call, and we look forward to continuing to drive strong growth as management of the company. Thank you.
Thank you.
Thank you.
Ladies and gentlemen, if you have any further queries, please address it at irfan.raeen@linkintime.co.in. Thank you. With that, we conclude the conference call. Thank you all for joining us, and you may now disconnect your lines.